But let's take the discussion forward. Gentlemen, good afternoon. Thank you so much for joining us, Saurabh and Mr. Subramaniam. Let's start by Saurabh. Now you've been running at your own outfit for some time now, and we understand the way it's scaling up. You must have met a lot of new investors across the length and breadth of the country, HNIs. Did you see it come? Did you see this big flows coming to the market, DIY investors, etc., all that we keep talking about, taking the market to new highs?
So Ajay, I think yes and no. So when we set the firm up 2.5 years ago, we set it up expecting the financialization of savings in our country, which is, middle class people, high net worth investors, gradually moving away from physical savings into financial savings. And over the last 2 years, we've seen enormous evidence of that. A lot of our clientele is from small towns and cities, places like Erode, places like Jhajjar. A lot of these clients have come from towns that actually I hadn't heard of till we started life in Marcellus. And it's remarkable to see doctors, dentists, car dealers, cloth traders from all across the country calling up Marcellus and giving us their life savings. Where I have to confess we got a little worried was last March as the panic got hold. I think I was on your channel on the day we had a gap down. And that evening when we did a webinar with our clients, 1,200 clients dialed in from various parts of the country. And the tension was tangible. In mid-March, the tension amongst the Marcellus client base and amongst H&Ws was tangible. Clearly, the mood has turned, and it's turned for the better. And I think this run will, I think, firmly put the foundations of the financialization of India's savings. The move towards firms like Sunil's, the move towards the mutual fund community, the move towards equity investing, the move towards PMS, AIF, the entire equity community will get a stimulus that it probably hasn't received, honestly, for the last 10 years.
Well, that's correct. And you did speak about the way Indian markets and emerging markets usually do after a crisis, a rebound actually happens and stimulus happens in the US. We'll talk about that. Sunil, we've been talking for a very long time, and I remember you were one of the boldest and loudest advocates of buying, even in the correction time after 2017, big correction came in, 1920, difficult periods, that, one should not really waste this opportunity. And here we stand. Your point is vindicated. Did you get the same kind of... I remember a lot of opposition also on several public platforms by other, participants. But now when you go back to your clients, your hypothesis is exactly playing out, isn't it?
Yes, I do feel a sense of vindication, because ultimately, what was the reason I was saying that was ultimately that economic growth has to reflect in the financial market growth. There's no two ways about it. And second is the market always tries to predict the future. So what is happening is that when there is a correction, market is saying there's a downturn coming, but it's not saying that there's a permanent downturn. So when the market is doing and you're a contrarian there, you know that the market is going to read an upturn well before the upturn happens. And if you're invested in the market, you're going to capture that upturn well before that. So the reason very simply is the combination of these two factors. The long-term correlation between economic growth and market growth. And the second is that the market being a harbinger, and you can't do a tandav. You can't keep jumping out saying market is now saying it's down, so let me come out and come back in, because market participants are a range of participants. There are long-term players who actually do this contrarian buying. There are short-term players who do profit booking. But you as an investor, you just align yourself with the long-term player. In the long run, the upturns will far outweigh the downturns, which is what exactly the last 9 months, 10 months since the downturn has shown us, right? So I think that's a very key aspect, and I hope investors have learned that staying invested and time in the market is much better than timing the market. I think that lesson hopefully has come through to people.
Right. Let's look a little forward, not to really forecast what's happening, but let's assess the probabilities. Saurabh, I understand you and your team have done some phenomenal work in assessing how economies, large economies, with the help of central banks, try to rebuild themselves out of crisis, out of recessions. Give us some feedback. A lot of new viewers are watching out. Typically, how does that happen? And in terms of the relationship between US and emerging markets in terms of rebuilding and stimulus, etc.? The point which you have worked on earlier as well.
So I think there's two sources of research which all of us can draw a lot of strength from, especially those viewers who are getting jittery about Sensex at 50,000. The first is that if you look at the last 100 years across the world, every exigency like COVID has been followed by 3-4 very strong years for the stock market. So 1918 to 20 was the great flu, this great Spanish flu as it was called. That was thrice as lethal as COVID. And yet the next 4-5 years after that, global equities, US equities, British equities had a very powerful bull run. Then obviously the Second World War, the S&P 500 rose 80% during the war and continued its bull run after the Second World War ended. Then if you go into the aftermath of the great financial crisis, we all know the bull run that followed both in India and in the Western world. So whether you take financial crises, epidemics, wars, what we've seen in the last 100 years is the economy recovers, consumption recovers, and the stock markets do very well for 4-5 years after a exigency. And it's not very hard to figure out why. Once you give a concerted global stimulus, right, like the one we've received in the last 9 months, like the global stimuli we received in 2008-9, if you give a concerted global stimulus, you synchronize a global economic recovery, you are overcoming one of the biggest handicaps in conventional economies. The conventional economy handicap is, I don't know whether I should view CapEx as Marcellus, because I don't know whether my clientele will be positive about markets. If I don't do CapEx as a say financial services company, you as ET now might say, well, we don't know what will happen to advertising revenues, right? What a concerted global stimulus does, it synchronizes everybody. You can see this very clearly in the car industry. Auto ancillaries are planning CapEx because auto OEMs order books are full. Auto OEMs are planning CapEx because interest rates are down 2.5%. People want to buy cars because interest rates are low and they need cars. So the entire auto industry, as we've been discussing on your channel for the last 9 months, has gone into expansion mode, right? So that's the first sort of bit of research, very clear data. After an exigency, you have 3-4 years of strong economy and strong stock market. The other thing is about India. The last 40 years of Indian history, absolutely crystal clear data. US recession in year T, Indian economy booms in T+1. Why? Because the US recession brings about a 50 to 80% correction in the price of oil. We as an oil importer benefit. Secondly, a US recession drags down the US 10-year bond yield by 2.5%. The RBI passes it on to you and me through repo rate cuts. The US recession, therefore, is cheap oil and cheap money. The Indian economy booms. And we've been shouting this out from middle of March. Hopefully, as we see the economy lift up through the winter, people will start understanding that the US economic recession in year T means that next year the Indian economy revs into high gear. My reckoning is the capex cycle will start this summer. We're already seeing tangible evidence of that.
Great point, Saurabh. Thanks very much for bringing that out so clearly. Sunil, your house historically has specialized in mid and small cap end of the market. Of course, now it's got a full bouquet of services, but I'm talking about a couple of years back. And in fact, in my assessment, one of the best grips of the small cap in terms of research, or even what kind of feedback is your team giving in terms of what is the financial health and fundamentals of the mid-cap end of the investing universe? The only reason I'm asking you is that when frontlines rally so hard, the investor community starts looking towards mid-caps. Surely a basket is a better way to approaching mid-cap, small-cap via funds such as yours. But what's the health and what's the outlook of broader market as your team is giving you feedback about?
So one is that this time, you see, the recession was on the services and consumption area of the thing. That was the impact, the lockdown and everything, right? But what happened is that the moratorium, and I think, people were criticizing the government for not giving away money. People were criticizing, but if you see, actually all of that has paid off because the NPA cycle. So in the mid and small cap, their biggest problem is two things: high fixed cost, one component of which is high interest cost. So this is what makes their P&L very volatile compared to a large cap company. And the stock market reflects that. So when they fall sharper. When they rise higher because the EPS grows higher. But this time around, the fall has been cushioned by the fact that RBI stepped in with this moratorium and then the restructuring. So the interest cost related burden has come down. The fixed cost burden, otherwise they have invested in plant and machinery, demand collapsed. So that impact was there. But then the point is that that is a high leverage impact, because when it comes back up, there is no interest cost or additional depreciation cost taking away from the profits. So the rise from a fall is far higher than the fall from a rise. I don't know, I said it in a complicated way, but the way math works. So what has happened is actually the only problem for mid and small caps in a downturn is that they shouldn't go out of business. As long as they have a survival mentality, as long as they can hang in there and see through the downturn, the benefits of the upside are far greater. And so that's what we are seeing in the mid and small cap universe, by and large, except for certain pockets like the hotels or malls and all that, where there was a severe impact, right? Most of the cases, they have managed to hang in there. And now the bounce back, which is occurring in the economy, every single number projected, I think RBI has said even today, that the Indian economy's numbers are going to far beat their projections. So this more than anticipated rise and the quick rise, and that's where I think the important thing here is to imagine that the harshness of the government's action on the lockdown, which led to the 23% negative GDP growth, is what has contributed to the bounce back in the economy, because you have prevented this from hurting our economy real time. So mid and small cap has most of the companies have managed to tighten their bills. And as Saurabh pointed out, the drop in oil prices, lots of mid-cap companies, auto sector, all, the inputs, the derivatives, they're all crude derivatives which go into as raw materials. So in addition to this, mid and small cap companies have got the benefit of a reduction in their input costs for all this, rubber, everything is related to petrochemical industry, right? Paint. So both these factors, and that is where Saurav's point was probably very relevant to the mid and small caps, that when there's a US recession and interest rates and crude price drops, that really helps all these high leverage companies in the mid and small cap to see through that downturn. They're going to get impacted because demand is affected. But when it bounces back, these prices don't bounce back so fast. So I think the health of the mid and small cap universe has turned out to be far better. And the market, as I said, and ultimately, I just now said, right, that the market is the indicator of the future. So a 1 year return, who would have said in March that you come to December 2020, right? Forget about today's 50,000 census. December 2020, the small cap index outperformed the mid cap and the mid cap index outperformed the large caps for the calendar year. Incredible. If I had said this in March, people will say, "Arey, put him into a mental hospital." Right? But that's the reality, because the market is reading the revival of the hanging in their mid and small cap, those who have survived with the bad time. The only danger is they shouldn't go out of business. And that, I think, is one thing. The other thing which happens, Ajay, is that at this time, because these two come down, mergers and acquisitions set up a lot. So within the mid-cap universe, within the small cap, you're seeing lots of mergers and acquisitions at reasonable valuations take place. And those post-merger companies are obviously bigger, stronger, healthier, able to maximize the upside. So I would say we are pleasantly surprised with the way the overall mid and small cap companies have in fact recovered. In fact, I think Marcellus, their strategies on the mid and small cap, you'll see, would have outperformed the ones on the large cap side. Same is true with us. We also have a portfolio management called PACE.
Oh yes, that's correct. These guys are definitely doing very well. Right, I'm sure that that entire category is doing very well. Thanks very much, gentlemen, both of you, Sunil and Saurabh, to join us on this very interesting day and covering this entire journey with us.